Hey everyone, I'm Ara Oghoorian and welcome back to our channel. Happy 4th of July. I spent most of the day reading the new tax bill that President Trump has just signed into law. So I spent the past few hours reading the 870 pages of the tax bill. Now, if you've seen some of my other videos, you know that there's been several versions of the proposed tax bill and what was passed by the House and what was passed by the Senate. But in this final version, and I'm going to go over all the details of what actually passed and what was signed by the president in this video today. Now, in the 870 pages, there's a bunch of different sections in there. So that covers energy, it covers border, it covers defense and Medicaid. But today I'm just going to focus on the tax implications, or the sections that are primarily focused on taxes, because obviously my viewers are primarily focused on the tax part of it. So without further ado, let's jump right into it and go over each of the sections that I think pertain to some of the things that you guys want to listen to. Okay, the first one is a no tax on tips. So this was pretty much in all the versions of the bill, whether if it was the House version or the Senate version. It was also one of the priorities that Trump had during his campaign trail. And it's finally made it into the final version of the bill that was passed and signed by President Trump. Now, the details of the no tax on tip is what we're going to go over today. Essentially, it's a 25% or $25,000 above the line deduction on tips that you receive, or tips that are received by people who are in the tip industry. And what I mean by a above the line deduction, it's essentially before the calculation of AGI, the adjusted gross income. And this is very important because the AGI is used for a lot of different things, for qualifying for a loan or qualifying for certain types of benefits. So to have this be an above the line deduction is actually a really good thing. Also, obviously to qualify for this, there has to be a lot of other, details associated with it. One of them is that the tips have to be reported on your W-2. So they cannot be cash tips. They can't be, other forms of tips. It has to be actually reported on your W-2. And I suspect they're going to amend the W-2 or have some sort of a box on the W-2 that's going to show reported tips, just like they do for 401k plan contributions and employer provided healthcare. I'm sure they'll add another box line item with a code that's primarily for tips, so that way they can track it. Also, an important part of the no tax on tips is that the tips that you receive that you're going to get a deduction for, you still have to pay payroll taxes, which are Social Security taxes and Medicare taxes. So while you may get a deduction of up to $25,000 on tips on your tax return, you're still subject to the payroll taxes on that $25,000. So keep that in mind, because you're still not avoiding that. You're only avoiding the income tax associated with these tips. The other thing is that it only applies to businesses or individuals who are customarily in the business of getting tips. So, for example, people who are like Uber drivers or servers or people in the hospitality industry. And this is to prevent people who are not in those industries, such as like an office worker, from all of a sudden now taking $25,000 of their salary and then saying that was actually received in tips, so that way they can get a tax deduction. So it's really done to kind of avoid something like that, but it's geared more towards people who are customarily, in the business of receiving tips. Like I said, those industries I just mentioned. Also, it's important to note that this no tax on tip expires at the end of 2028. So it's a temporary tax relief from the year 2025 until the year 2028. So the other thing that made it into the final bill is the no tax on overtime pay. And this was also another campaign promise by Trump. It was in the House version and the Senate version. It had like different variations of it, but it did finally make it into the final bill and it was signed into law. And the idea behind this is that millions of people work overtime and they pay tax, not only income tax, but also Social Security tax and Medicare tax on this overtime pay. And just like tips, where no tax on tips is exempt from federal income tax and is subject to payroll tax. The same principle applies to the no tax on overtime pay. So while there's a deduction for overtime pay and it's going to get reported on your W-2, you still are subject to the Social Security and Medicare tax. So keep that in mind. And the idea is that it's targeted tax relief for people who are hourly workers that work a ton of overtime pay. And it starts in 2025. It's also temporary. It's from the year 2025 until 2028. So it's only 4 years. And there are some income limitations to it. So starting in 2025, essentially, if you're single, you get to deduct up to $12,500 of tips. If you are, not tips, of overtime pay. If you are married filing jointly, then that threshold is $25,000. However, as I mentioned, there are income thresholds, so income phase outs. In order to qualify for this no tax on overtime pay, if you're single, your income has to be less than $150,000 a year. And if you're married, your income has to be less than $300,000 a year if you're married filing jointly. And when I say income, I'm referring to modified adjusted gross income. Modified adjusted gross income, if you're not familiar with it, I have another video on that where I define the differences between adjusted gross income and modified adjusted gross income. And for the majority of people, the difference is if you earn tax exempt interest. The past few years, a lot of people have been buying treasury bills which are exempt from state income tax, which is great because it's a good yield and you don't pay state income tax, especially if you're in a high tax state like California and New York. But what's not good is that when they're calculating the threshold for the no tax on overtime pay or the no tax on tips, they're looking at the modified adjusted gross income, which adds back any interest that you received as tax exempt interest. So keep that in mind when you're trying to determine your eligibility for these types of benefits, because if you do earn tax exempt interest, that does get added back to calculate your modified adjusted gross income. Hey, if you like this video, please remember to like, subscribe, and share our channel. And if there's a topic that you want me to cover in a future video, be sure to include it in the comment section below. I'd say one of the biggest things that made it into the final bill, and thank goodness because that was going to expire at the end of this year, is the Tax Cuts and Jobs Act that was passed under Trump's first term. And if you're not familiar with the details of the Tax Cuts and Jobs Act, I have done another video on that where I define all the different provisions of the Tax Cuts and Jobs Act as it relates to individuals and businesses. But the Tax Cuts and Jobs Act is now made permanent, which is a great thing because essentially it makes the new tax brackets that were passed under the Tax Cuts and Jobs Act permanent. And those tax brackets start from a low of 10% all the way up to a high of 37%. But what it also does is it makes the standard deductions permanent and indexed for inflation. So the standard deduction if you're single or if you're married filing separately is $15,000 a year. And if you're married filing jointly, that's $30,000 a year. And if you're a head of household, meaning if you have a child that you take care of or a parent and you take 50% or more care of that individual and you qualify for head of household, then your standard deduction is $22,500. Another piece of this Tax Cuts and Jobs Act that was hotly contested and it was really uncertain what was going to happen in the final bill is the SALT deduction. And if you're not familiar with the SALT deduction, it's essentially the state and local income tax deduction. Essentially, before the Tax Cuts and Jobs Act, if you are allowed to deduct, if you're an itemizer, if you itemize your deductions and your taxes, you were able to take your you were able to deduct your property taxes, your mortgage interest, and charitable deductions on Schedule A and get a deduction on your taxes. Well, under the Tax Cuts and Jobs Act, it severely limited the amount of property taxes and local income taxes you paid on your tax returns. So it capped it at $10,000. And it made it really difficult for people who live in high tax states such as California and New York, because if they're paying a ton of money in property taxes before they were able to deduct most of it, now they were capped at $10,000. Well, like I said, this is a hotly contested issue because representatives from those high tax states were really pushing for some sort of reform to have that changed. Well, what it did was it temporarily increased the SALT deduction to $40,000 from the current $10,000. And that's from the years 2025 until 2029. But it also creates a cap, an income threshold, again, using the modified adjusted gross income to $500,000. So to be able to take advantage of that higher SALT deduction, your modified adjusted gross income has to be less than $500,000. But luckily, that income threshold increases every year by 1%. So that, in 2025, it's 500,000, and in 2026, it's going to just incrementally increase by 1%. After 2029, it reverts back to the $10,000 limit. So keep that in mind. Luckily, the pass-through entity tax that a lot of states passed as a workaround to the SALT limitation, that did not get eliminated. So what the pass-through entity tax workaround is, and I've done a video on this as well, you can take a look at that. Essentially, it allows people who are living in these high tax states that were capped at that 10,000 and they were a business owner to be able to pay a tax on their business tax return and then get that credit on their personal tax return. So it's kind of like a workaround, a way to circumvent that SALT limitation for them to be able to get that higher deduction. So luckily that didn't go away. So if your property taxes are more than $40,000, you can continue to use that pass-through entity tax loophole after 2029 when it goes back to 10,000 cap. And you're a business owner, you can again continue to use that pass-through entity tax workaround. Another huge benefit of the new tax bill is the increase in the QBI, which is a qualified business income deduction, also known as a 199A deduction. If you're not familiar with this one, I've done several videos on what is the QBI deduction and how to calculate it. This is a huge benefit for business owners, pass-through business owners, not C corporations. And essentially, it's a 20%, what used to be a 20%, now is 23%. So if your business, let's assume, earns $100,000 a year, you have, let's say, for example, an S corporation, and it earns $100,000 a year, you get an automatic $20,000 deduction against that income, which is huge. This bumps that up to $23,000, again, which is huge, a huge benefit for small business owners. And I say small business owners because it caps the QBI deduction has income eligibility. So you can't be making millions and millions of dollars a year and benefit from this QBI deduction. It also has eligibility criteria for people in certain industries. So if you're in a service industry, also known as a specified trade or service, then you're ineligible for the QBI deduction. So those are industries such as CPA firms, lawyers, medical practices, architectural firms, really anything that's in a service-based industry like consulting. They don't qualify if your income is above a certain threshold. Another deduction that was mentioned during the campaign trail and actually finally made it into the finalized bill that was signed today is the auto loan interest deduction. Essentially, and this, by the way, is also temporary, so it applies only from the years 2025 until 2028, and it allows buyers of cars that are made in the U.S., they're actually assembled in the U.S., so not made in the U.S., they have to be assembled in the U.S. It allows the people that are borrowing to buy those cars, and they have to use the car as collateral, to be able to deduct up to $10,000 a year of interest unpaid on those loans. So that's a big benefit for someone who's thinking about buying a car and is able to take up to $10,000 of the interest they paid on that as a deduction. A couple of important notes is that it only applies to residential cars, so you cannot do this for your business because there's other benefits of deductions for business owners for cars, so it has to be used for personal purposes. And the car cannot be more than 14,000 pounds. I mean, I don't know of any really residential car that's more than 14,000 pounds, but I'm sure there are some out there. But it has to be under 14,000 pounds to be able to qualify for this benefit. Also, your income, you have to meet certain income limitations. If you're single, your income cannot exceed $100,000. And if you're married, your income cannot exceed $200,000, married filing jointly. And when I say income, I'm going to refer back to modified adjusted gross income, as I said earlier. And again, if you're not familiar with the modified adjusted gross income and how that's calculated, look at my other video where I compare the modified adjusted gross income to the adjusted gross income, so that way you can see the differences between the two. Another provision of the finalized bill are these things called the Trump accounts. Now, the Trump account, there's some information about it, but essentially it's a little bit vague because there's a lot of things that are missing from the Trump account from the final bill. And I suspect there's going to be much more guidance on this going forward. But essentially, it's an entirely new type of account. And the goal behind it is to give families with young kids a financial head start in life and to get them exposed to investing. The way that it works is you can open up one of these Trump accounts. You can put up to a maximum of $5,000 in this account up until the year the child turns 18. Once the child turns 18, you cannot make any more contributions into this account. Also, if your child is born between the years of from January 1st, 2025 until December 31st, 2028, the federal government will give you a boost. They'll basically fund $1,000 of this account for you as a benefit, kind of to get you going in this account, which is a massive benefit for young families that are starting out and they want to get their kids going on the right foot with investing and savings. A couple of other points related to these Trump accounts is that they're limited on certain types of investments you can make in it. So you can't put the money in like Bitcoin or cryptocurrency or individual stocks. It has to be an indexed fund or a mutual fund. And not only that, it has to be an index fund or a mutual fund that has an expense ratio of no more than 0.10 or 0.1%. So most index funds that are that track, like for example, the S&P 500 or the NASDAQ, they're pretty low cost. So they don't want you buying funds in your Trump account that are going to be high cost funds. And if you're not familiar with the differences between a mutual fund and an exchange traded fund, again, I've got another video that goes through the detailed differences between those types of accounts and which one is a right choice for you depending on what your objectives are. Now, these accounts don't allow distributions up until the person's 18 years old unless they're called qualified distributions. And a qualified distribution is something that is either for education or a first-time home purchase. But the bill is pretty silent on other types of distributions, the taxation of them. So for example, what happens after the child turns 18? Is it going to be tax deferred? Is it going to be tax free? Is it going to be taxed as capital gains income? That part is still kind of unknown because I couldn't find anything on it in the final bill. But that's why I said earlier that I suspect there's going to be much more guidance on this going forward because right now it's unclear how those funds are going to be taxed once the money comes out. So another portion of the bill is called a senior tax relief. And this is really to appease the seniors that were waiting for the no tax on Social Security. If you recall, this was a big campaign promise. It was introduced in one of the bills, one of the many versions of the bills, saying that they were not going to tax Social Security. Well, that didn't make it into the final bill, unfortunately. So to appease some of these seniors, there's now a temporary bump up in the standard deduction. It's a $6,000 additional deduction on top of the standard deduction for people who are age 65 or older. And again, this is temporary. It's only from the years 2025 until 2028. A couple of things happened also with the child tax credit. The child tax credit was made permanent. Under the Tax Cuts and Jobs Act, the child tax credit was doubled, and then it was set to expire at the end of this year. But this bill made it permanent, and it also gave it an inflation adjustment. So now it's going to get adjusted for inflation. But on top of that, it gave it an additional boost for the next few years. So right now it's $2,200, and there's a temporary boost in 2025 to $2,400, and then starting in 2026, it gets adjusted for inflation, but based on the $2,200 base rate from 2024. So it's a little confusing on that part, but the bottom line is there is a boost of the child tax credit. And it's also made permanent, and it's also indexed for inflation. So it's a win-win essentially for parents that have young kids. I mentioned earlier how the standard deduction was now made permanent under the Big Beautiful Tax Bill, permanent from the Tax Cuts and Jobs Act. But what it also did was it gave a temporary boost to the standard deduction, and that's only from 2025 to 2028. So the standard deductions from Tax Cuts and Jobs Act, those are made permanent; those don't change, but In addition to that, there's a temporary boost from the years 2025 to 2028. And the additional boost depends on your filing status. So if you're single or married filing separately, it's $16,000 versus the $15,000. If you're married filing jointly, it's $32,000 versus a $30,000, so it's a $2,000 bump. And if you're head of household, it's $24,000 versus the $22,500 under the permanent standard deduction. Another thing that was on a lot of people's minds is the estate tax exemption. So if the new bill had not been passed, the estate tax exemption would have fallen significantly below its current level. And what the big beautiful tax bill has done is now set it at $15 million starting at 2026, and it's also indexed for inflation. And if you're not familiar with the estate tax exemption, I have another video where I talk about that. But basically, upon your passing, it's the sum of all your assets, value of life insurance, your home, your car, retirement assets, everything put together. And if it exceeds a certain amount, then your state has to pay an estate tax. So this bumps up the level up to $15 million starting in 2026, and again, indexed for inflation, which means that you're not going to be subject to that estate tax until your estate goes above that amount. Another thing that got expanded significantly is the qualified small business stock, also known as the QSBS exemption. Essentially, and this is actually not a new exemption. This has been around since the Clinton administration when it first passed, and then it got expanded during the Obama administration, and it got expanded even further under this new bill. And the way that it works is it's to encourage people to invest in businesses and to hold those investments long term. Generally, if under the current law, if you buy an investment in a stock, not just any stock, it has to be a small business that qualifies, and you hold that investment for at least 5 years, then you can exclude up to $10 million or 10 times your stock basis, whichever is lower, and pay no federal income tax on it. So it's a huge boom for people who had startup companies, and those startup companies ended up having a tremendous value increase in them. And under this new rule, it basically accelerated some of that time period. So instead of having to hold it 5 years, now you can hold it 3 years. You get a smaller deduction, but at least you don't have to hold it at least 5 years. But if you hold it 5 years, you get the full 100% deduction. Also, it increased the exemption from $10 million to $15 million. So now you can get up to $15 million of tax-free, no federal tax on the capital gains of that stock. The other thing is it changes the size of the company. So before the current law, the maximum value of that business could not be more than $50 million. So if you started a business and that business grew to $100 million, then it would not qualify. But if it was under $50 million, then it would qualify. The new tax law now changes that to $75 million. So you still have to be below the $75 million to qualify for QSBS stock. And then lastly, QSBS stock excludes service-based businesses. So if you are in a business like accounting, law, consulting, doctors, medical practices, those industries are excluded from QSBS stock. The other thing that was extended and made permanent under the One Big Beautiful Tax Bill is the bonus depreciation. Essentially, the bonus depreciation is when a business buys some sort of a capital equipment, let's say it's machinery, or usually it's machinery, but something capital equipment to help their business grow. That business can either spread that expense over several years, known as depreciation, or they can deduct that entire expense in that 1 year they purchased it. For example, if a business bought a piece of machinery and it was $100,000, they have the choice of spreading that $100,000 over several years and deducting it over those years, or they can take that entire $100,000 and deduct it in that same year they purchased it. That's called bonus depreciation. And what the One Big Beautiful Tax Bill did is it made that permanent and allowed the 100% depreciation or bonus depreciation of those types of equipment, of those types of capital purchases by businesses. So another interesting thing that got into the final bill is a limitation of gambling losses. And starting in 2026, you're only able to deduct 90% of your gambling winnings, even if you lost more than that. So let's assume that you went to a casino and you won $10,000. but you lost $12,000 in the same year. Well, under the current law, you were able to deduct $10,000 of those losses because you had $10,000 of losses and you had $12,000 of winnings. But under the new rule, under the new One Big Beautiful Tax Bill, you're only able to deduct 90% of those winnings. So only of that $10,000, you're only able to deduct $9,000 of it using that same example. So as you can see, this tax bill is quite extensive, and I only covered the sections that relate to individual taxes and business taxes. As I mentioned earlier, I didn't even cover the sections on border, on defense, on energy, all those things that really don't apply day to day for individuals and businesses. I didn't cover, and there's over 870 pages of the bill. But the bottom line is it creates a lot of tax planning opportunities for both individuals and businesses, because a lot of these things are permanent. Some of them are temporary. Some of them have income limitations. So there's a lot of moving parts, and it's really important for you to meet with your tax preparer and make sure that you do qualify for some of these things and see what you can do to work around. I would say, one of the main highlights of this is probably the increase in the QBI deduction, which is made permanent. The QBI deduction is a really big benefit for small business owners, and for it to go from 20% to 23%, I think is a huge advantage for small businesses. Also, the permanency of the tax brackets from 2017 from the Tax Cuts and Jobs Act, making those permanent, and the standard deduction, also really big benefit for individuals and businesses. Hey, thanks again for watching. I suspect there's going to be a lot of new guidance that comes from this finalized bill, and it's going to create a lot of planning opportunities. As new things come up, I'm going to continue to do new videos and educate and update everyone, all my viewers, so that way you're up to date on everything that's going on a personal tax side and also on the business tax side.